You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. That music means it's time once again for Options Playbook Radio, the program here on the old network where we break the sometimes scary, sometimes impenetrable world of options down into some simple offensive and defensive plays that you could use in your own portfolio. Maybe you want to go on offense, generate a little bit of income, get a little bit of capital appreciation. You want to go on defense. You want to protect some gains and lock in what you got in your portfolio. Either way, we got you covered. My name is Mark Longo from the old Options Insider, as well as, of course, from the old network. If you're saying to yourself, hey, I know that guy, he's not the usual guy on this show, you are correct. So allow me to introduce your usual host here and the senior options analyst, a.k.a. the options guy over there at Ally Invest, Mr. Brian Overby. Brian, welcome back to your own show, sir.
Well, thank you. It's great to be back. And I always love when we can get together and answer some of these listener questions because they really do pile up in the inbox. But in order to do that, we always have to huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via questions@theoptionsinsider.com, twitter.com/options, facebook.com/theoptionsinsider, or via the Trader Network at tradeking.com.
All right, everybody, welcome to the Huddle. Like Brian mentioned, this is the portion of the show where you guys take the reins, your questions, your comments. Sometimes I like to turn the tables on you guys a little bit and ask you some questions as well. Brian, we like to ask our listeners a fun poll question every week, kind of get them playing along. You guys, as always, can play along at options over there on Twitter is where the polls are based usually. So get on over there, follow us. You'll know when all the polls go live. A lot of you have already chimed in on this one. It's one of your favorites. Brian, I'd be curious to get your thoughts as well. We asked everybody this week, so, everybody loves trading Apple. It's one of the top names, most active every single day. So the open interest, always very high. But a few interesting options positions tend to dominate the rest. What do you guys think is the largest open options position in Apple right now? This was posted a couple of days ago. This was as of the time of that posting. It could have changed, but I don't think that is the case. And no cheating, no looking it up on Ally or your broker of choice. Try to use your gut. Try to use your spidey sense. We gave you 4 choices. The Jan 2020 200 call, so a little bit of long-term upside there. The plain Jan 250 call, so very optimistic. The Dees 180 put actually was out of the money and now kind of in the money put. Or the Jan par, aka the Jan 100 put. Brian, I've seen the answer. I know the data, so I am not allowed to play. But right now, our audience is firmly in the Jan 2020 200 call camp, with about 42% having chimed in now for that versus about 24% for the Dees 180 put, 21% for the Jan 250 call, and 13% for the Jan par put. If you guys haven't played along, you got a few more days left, head on over to @options, make your voices heard. Brian, I know it's probably hard to resist looking at your options chain for the data, but I'm curious, what is your spidey sense? What does your gut tell you think is the biggest open position in Apple right now?
Well, I'm looking at it, and I just think of the volatility in the market. I mean, there's the one oddball that's, the nearest term option here, or the closest to the money is really where I would go. I guess if I had those choices, my guess would be the 180 put.
Interesting. I can neither confirm nor deny on the air that you are right. I will instead say to our listeners, I'll type the answer to you then in our show chat so you can see the answer. Our listeners, unfortunately, you'll have to tune in, I think, to Volatility Views at the end of the week where we'll reveal the answer. I don't want to give it away now. I still got a few days left to play along. But right now, Brian's taking the number 2 shot with the Dees 180 put. 24% of you saying that, with about 41% of you saying the Jan 2020 200 call. Get on over there, make your voices heard, just like our next listener here, actually. All right, first up on the huddle, we've got a question here from Ellen Niels, or maybe Ellennials. I'll go with Lennials. It sounds cool, kind of rolls off the tongue. Lennials asking here, given the skew set up in equities with calls being cheaper than puts from a volatility perspective, why would you ever buy a collar? Why doesn't everyone always sell the skew and use bullish risk reversals? The market seems to be set up for it. Excuse me. This is a great question. We touched on similar themes on some of our other programs recently. I think we had someone write in with a similar question on TWIFO of all shows last week, talking about the skew setup in commodities. But you can make a similar analysis to the equity side of the fence. Remember, listeners, a collar, of course, involves having an underlying and then buying a protective put and selling a covered call to finance it. So what he's mentioning here, of course, is that in equities, the puts are always more expensive from a volatility perspective than the calls are. So you're always kind of paying a premium to do that. So why would anyone do it? Why wouldn't anyone go the other way? It's an interesting one, Brian. I know you like talking about collars and risk reversals and things like that in the old playbook. I'm curious, what do you have to say here for our friend, Mr. Maybe probably Mrs. because it's Ellen, Mrs. Millennials here. Why? I'm a fan of a bull. Maybe we'll start there. Are you a fan of a bullish risk reversal? I'm always a big fan of that. And then B, why does everyone just do that instead of own the stock? Why go the collar route?
Well, first of all, do you think that this is short for millennials?
It kind of sounds when you pronounce it that way, it kind of does, right? So, yeah. But it's got the Ellen in it too.
I hear millennials when you say it.
Yeah, it has a little bit of millennial. So maybe she's a millennial. I won't hold it against her if that's the case.
I think she's got creative, and I think it's actually a really neat handle. So in general, put calls. So when you're doing a collar, you're giving up potential upside so that you have limited and known downside. And people usually will do this on a stock that they've owned for a while, and maybe they want to push it out. We actually did a segment in the Options Playbook Radio not that long ago talking about collars and trying to use them for some tax advantages going out into the new year. So what you're really focusing on volatility skew here, but what really affects collars more than anything is interest rates. The prevailing interest rate in the short term, whatever basically expiration that we're looking at, affects the collar more than almost anything, because there's an old strategy called put call parity down on the trading floor, where you synthetically get long stock and you synthetically get short stock, and it basically looks exactly like a short stock position, but you don't have to put up all the capital for buying the stock outright. So the difference between the synthetic position that we talked about, which is basically a collar in general, and the actual stock position is that for actual stock, you got to pay for it. And for synthetic stock, you don't. So the interest rate, so the synthetic stock is naturally going to be cheaper on a cost of money basis. So if you do the trade and everything being equal, that has to get figured in to the synthetic stock position. So that's actually going to trade a little bit higher than the normal stock because it has to, or else there is an arbitrage opportunity out there that if you throw in interest rates that the marketplace will do to drive the prices back in line. So if interest rates are higher, that actually makes owning stock in that scenario, if interest rates are high, owning stock is bad because you could earn more money on your free cash. So collars, people mistakenly get excited about, like let's say interest rates went back to 5% prior to 2007. You could see money market funds at 5%, 6%. And with that being said, you would see collars would trade very, very nice, because you could sell the calls for higher costs because of cost to carry and buy the puts for lower costs. But really all you're looking at was the risk-free interest rate and how that gets priced into the marketplace. So I always find collars a great tool that everybody should have in their toolbox. And it's not necessarily that I'm going to go out and just do a collar, but I'm going to look at positions that I have. And when I want to minimize risk, I love to try to get some protection without paying for it. And that's really what a collar is. I own the stock, I sell a call to help pay for my protection, which is a put. So overall, when I don't worry, I really don't think that the skew has as much to do with collars as interest rates. I guess that's the moral to my story.
There's always, we talk a lot about collars on our advisors show. That seems where they come into play a lot, because that segment of the audience is typically long equity and they just love to collar all day long. I've often called the collar the holy grail options position for advisors and asset managers, because it is. It gives them the protection they want, gives them a little bit of a reduced cost to do that, gives them some income. That's a great position for that sense. But it makes sense for a lot of retail as well, I think, for the reasons you just described, particularly if you have a period like we found ourselves in a few weeks ago in the market, kind of top heavy. Things are getting a little bit concerned. You're worried. Maybe you don't want to sell out, but you also want to stop yourselves out to the downside. And also you don't mind maybe letting go of some of that position to the upside if it goes that way. Then a collar is an ideal. Again, you mentioned skew, but also the rates. Yeah, we've seen how the velocity of rates can impact the market these days, right? Maybe it's time for a row refresher. On the old options playbook radio.
I haven't said row in a long time.
I know, right?
That should be the Greek of the month, I guess.
It kind of is, just a row. I think I said it about a month ago on the network when everything sold off for the first time over the rates. I said, row snuck up on all of us. And I think the velocity of row was a good awakening moment for everyone. By the way, I should mention, we're raising the stakes on the Huddle this time, Brian. At the end of this episode, you're going to go back and pick which was your favorite question of the episode, and that person's going to win themselves a nice brand spanking new hard copy of the playbook. So listeners, bring your A game. All right, and let's see. Since we started off with Apple, it kind of makes sense. Let's have an Apple-related question to finish it up. We actually have two that are kind of related. They're kind of Apple and volatility together, which is kind of fun. The first one comes from Bortega. He wants to know, why are there no options on VXAPL, which is the Apple VIX, and will there ever be options listed on this product? I guess in a related volatility theme, we have another question here from Union J, who says, will we ever have a VIX index product that we can actually buy and sell? Of course, listeners, if you listen to this show or any of our other programs on the network, you know that the VIX cash gets bandied about a lot as if you could actually buy and sell it, but you really can't. It's just an abstract index. The only tradable products out there are actually the futures and then the options on the futures. And there's a legion of ETPs that have spun off since then attempting to replicate that, like VXX and others, with a whole host of issues that accompany them. If you're curious about that, I recommend check out our Volatility Views program. We do a deep dive into a lot of those there. So a lot of stuff to unpack here. Let's start with the VXAPL, a.k.a. the VIX of Apple. Brian, maybe fill our listeners in on what the heck this guy's talking about, and then we'll get into if we're ever going to see options on this.
All right. Well, a great idea was to come out and take the VIX index, which the Chicago Board Option Exchange has been so successful with, just in the fact that it gets quoted on every national television show that talks about the markets, and it's quoted nonstop because it's known as the fear index, and it tells you a little bit about the marketplace. Even if you don't know anything about options, when people say, the VIX has gone up quite a bit, that actually says something to a lot of just individual stock players, because it's all about volatility. So somebody had the great idea, well, why don't we take popular stocks and make a VIX of that popular stock? And one of them is Apple. The symbol is actually VXAPL. That's VXAPL. And it's a volatility. It's basically a 30-day weighted volatility, just like the VIX, but it's only on Apple and only used with Apple options. Now, there are other ones that are very popular that are out there, and I don't even know the total at this point in time, but they got a VXGOOG for Google, GOG. And then they got a VX for Amazon, of course, VXAZN. I think there's one for IBM. There's a few other underlyings that they have them on. The bottom line is these are volatility-based indexes that really don't have an underlying on them. Now, the VIX index, it does trade options, and the reason why is what you mentioned fairly quickly in the intro is that there's a futures product that follows the actual VIX. And the best way that I've always been able to talk about this futures product or why it's so crazy relative to the actual cash or spot index is it's kind of like buying options on the weather. You really have no idea. The fact that the weather in Charlotte, North Carolina on December 31st is 70 degrees, which it was one year, I recall that, has nothing to do with what the VIX index, what the weather is going to be with on January 5th, for example. You just have, it's so hard to judge that. And the futures marketplace tries to do it. Well, they don't have that product right now. They don't have any futures on the VXAPL, the VXAZN. I don't know if the Chicago Board Option Exchange or some futures exchange was thinking about doing that. And that's where all of these rumors about being able to trade options on these volatilities happen. But if we don't have a futures market on it, if we don't have something to price in the future what volatility might look like, then bottom line is you can't have options on it. And I guess that sums it up, I guess, overall.
Yeah, these were launched with great fanfare a few years ago. They were expected to be the next big thing in the world of options and VIX. And yes, you're right, they never really amounted to a tradable product. The indexes are still out there, as you mentioned. You can go watch them, listeners. You can key off them as an indicator. They are still disseminated out there, but there are no tradable products off of them. And same thing goes off with the second question: will we ever have a VIX so we can buy and sell? Many people have attempted to tilt at that windmill, all of them pretty much without success. The most recent one being Professor Whaley, who was actually involved in the original incarnation of VIX itself. He attempted to create some ETPs that attempted to replicate that and created that sort of actual cash tradable VIX and a VIX up and VIX down type product. And if you go look up the history of that product and some of the machinations they had to jump through and the hoops they had to jump through and the distributions and everything else like that, it's such a complicated, difficult thing to do that I've yet to see anyone really crack it, including that product. So there's a lot more to it than just saying, hey, there's a VIX and I want to trade it. There's a lot more to it than that, and it's a very, very complicated task that some people think simply cannot be done, which is intriguing, and that's unfortunately where we are. It's unfortunate where we have to leave this episode. Before we go, Brian, you get the dubious honor of selecting our winner for the episode. Who are you picking, sir?
Oh, I always like to talk about collars, so I'm going to have to go with the collar. And I also like the handle.
I was going to say, you like the handle. That's what you liked. You like the handle. So it sounds like Millennials is our winner. We'll reach out to them and get their info. Meanwhile, Brian, if people want to learn more, maybe they want to participate on future huddles, where should they go? What should they do, sir?
Well, you can always email any questions directly to me besides over there at Options Insider Radio. But if you want to email me directly and have it come right into my inbox, you can send a message to theoptionsguy at invest.ally.com. That's theoptionsguy at invest.ally.com. Thanks for listening. We'll be back same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finished out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.